U.S. natural gas prices ended lower on Friday after an early rally failed to attract sustained buying interest. The market weakened steadily through the session before selling off sharply into the close. The main bearish driver was a shift toward warmer U.S. temperature forecasts, which reduced expected heating demand. From a fundamental perspective, weather remains the dominant factor. Traders are still mindful of the recent polar vortex that triggered a massive storage draw and production freeze-offs, especially in Texas. This time, however, the setup looks different. While cold weather briefly impacted the Northeast, futures traders largely ignored it, viewing the cold as short-lived and already priced in. Attention has shifted to the broader national outlook, which is increasingly bearish. The latest forecast expects above-normal temperatures across the Midwest and South through at least February 22. Weather analysts echoed that view, noting that overall U.S. demand should remain elevated through the weekend but turn relatively light next week. This warmer outlook helps explain the muted market response to the latest storage data. The EIA reported a record 360 billion cubic feet withdrawal for the week ended January 30. While the draw came in slightly below expectations, it pushed inventories about 1.1% below the 5-year seasonal average, signaling tighter balances. Still, traders showed little enthusiasm, suggesting the market is focused more on forward-looking weather and supply trends than backward-looking storage data. Supply concerns also weighed on sentiment. Lower 48 dry gas production was estimated at 112.6 billion cubic feet per day, up 6.2% year-over-year. Lower 48 demand stood at 104.5 billion cubic feet per day, up 11% year-over-year. LNG feed gas flows to U.S. export terminals averaged 19.6 billion cubic feet per day, up 6.2% week-over-week. Despite solid demand in exports, the market appears increasingly concerned that rising production will dominate the near-term balance. That concern intensified after Baker Hughes reported that active U.S. natural gas rigs increased by 5 to 130, the highest level in roughly 2.5 years. The higher rig count reinforced fears of stronger future production and added pressure to prices late in the session. For the week ending February 4, about 134 billion cubic feet of total LNG carrying capacity departed U.S. ports, up 16 billion cubic feet from the previous week. This highlights that export capacity is still expanding and operating at high levels. However, the market appears to be taking a more sober view. Despite rising LNG capacity, the U.S. is heading into a lower demand shoulder season. As winter fades, heating demand declines sharply, and historically this shift tends to prioritize seasonal demand weakness over incremental export growth. A similar dynamic played out in August 2025, when growing LNG exports failed to prevent prices from drifting lower as domestic demand softened. That period reinforced a key lesson for traders: LNG growth can provide structural support, but it does not eliminate seasonal price pressure. In that context, a more reasonable and sustainable price level during the upcoming low-demand period likely sits below $3.50, rather than near recent highs. Technically, price action confirms the bearish tone. Upside attempts were capped by the 200-day moving average near $3.77 and a short-term resistance zone between roughly $3.77 and $3.60. On the downside, the market closed just above the 50-day moving average near $3.40 and Fibonacci support around $3.28. If warmer forecasts persist, these levels look vulnerable, with the early February low near $3.15 emerging as a clear downside target. If you found this useful, consider buying me a coffee or sending a super thanks on YouTube to support the channel. A lot of time goes into the analysis and video creation, and at the moment it's simply not being paid for by YouTube. Without support, I may have to stop or make the channel private. Thanks to those who help keep this going, and maybe I'll see you in the next one.